if they draw it down to roughly zero down to the hour during the debt ceiling, and then they want to refill it, that's a $500 billion that wants to get sucked out of the market into this like liquidity void.
In today's video, Lyn Alden, an investment strategist and macroeconomist, warns that once the debt ceiling is lifted, Janet Yellen will need to refill the Treasury General Account.
What is your current assessment of the global economy and financial markets?
So I think we've hit some of a pivot point. We've gone from obviously aggressive tightening toward the Fed kind of running into somewhat of a liquidity wall, and now they have to balance financial stability with their attempts at fighting inflation. And so I think that's kind of the big story in financial markets, is this kind of pivot in liquidity. I think the challenge is that we're still in this kind of stall speed area. So a lot of economic indicators have decelerated without going negative. And so they're either mildly positive, roughly neutral, maybe in some cases mildly negative, and other ones are still pretty strong. And we have this kind of window here between now and the debt ceiling, where liquidity looks pretty flat overall. So the Federal Reserve was draining liquidity. Now it's kind of a messy situation. They're still, on one hand, they're pulling liquidity out with quantitative tightening, but then they're putting even more back in with loans. You have the Treasury General Account is still structurally drawing down its cash reserve as part of its extraordinary measures when it runs into its debt ceiling. And a lot of that's already behind it, but there is still some to go. And so as they draw that out, that goes out to the economy, and that's actually pro-liquidity. So you kind of have this multi-month window here where liquidity looks okay, but then the big challenge is that when they actually do get to the debt ceiling impasse, however that's resolved one way or another, when the Treasury actually then wants to refill its cash account and wants to, is able to issue debt again, that's a lot of new supply coming onto the market, and we're going to see how the Fed deals with that in terms of a liquidity response. And so overall, I would say we're kind of still in this multi-month period, but there's like storm clouds on the horizon. And there's almost two economies, right? So obviously very interest rate sensitive sectors, which is things that are really reliant on debt or issuing tons of equity, ironically. So if you look at the real estate sector, obviously that employs tremendous amounts of debt, and therefore that's very interest rate sensitive. That's obviously been a point of concern both residentially and commercially. And then the other one is tech. And people don't often think of it as a real estate, as an interest rate sensitive sector, but it is, because especially in this past decade, so many tech companies have in some cases sold their equity better than they sold their products. And what I mean by that is they keep their prices low, they operate at a loss, and they make up for it by constantly selling new equity, both to their employees and to investors. And that's what allows the company to keep going. And that works as long as interest rates are like zero and people are willing to just keep monetizing that equity. But when there's actually a cost of capital, that equity gets valued very differently. It's no longer economical to keep issuing tons and tons of it. And then the company has to raise the prices to try to close the loss that they're making. And then that slows down their growth because some of their growth was only there because their products were underpriced. And then as their growth slows down, their equity valuations fall further. And you basically find out that a big percentage of that business was malinvestment, that there really was no there. It was just a underpriced thing that wasn't getting its market signals due to manipulation. And so those are kind of the two sectors that are obviously most concerning. Whereas you don't really see much stress in the travel industry and the restaurant industry, in certain other parts of the real economy. There's kind of a bifurcated economy. So that's the rough magnitude. I mean, basically, it was actually starting in the beginning of Q4 last year. For the first 3 quarters of 2022, liquidity was falling because the Fed was doing quantitative tightening, and that kind of culminated in the Treasury market was getting very liquid by the end of Q3, and then you also had the gilt market blew up.
Sorry to interrupt, but that's when Janet Yellen began raising these flags of cracks in the Treasury market.
Exactly. And you also had the dollar index kind of hit its peak, and that all kind of ended up around the late September period. And the Treasury General Account started drawing down more quickly at that point. And you actually, measures of domestic liquidity started trending sideways rather than down throughout quarter four. And that kind of coincided with the dollar index coming off of its highs, the market coming off of its bottom. Treasury market liquidity still wasn't great, but it was no longer as bad as it was in that time. And so for kind of a multi-month period, we're in that sideways sort of trend. And that was in large part because the TGA was big enough to be offsetting some of the quantitative tightening. So that gives you an idea of magnitude. They drew it down from many, many hundreds of billions, and now it's below 300 billion. And so that was large enough to offset a significant percentage of quantitative tightening. Going forward, there's only, there's less than 300 billion left. It's still relevant on a scale. And when they get to a point where they want to refill it, I mean, their kind of baseline number for where they want it is around $500 billion. And so that's if they draw it down to roughly zero, down to the hour during the debt ceiling, and then they want to refill it, that's $500 billion that wants to get sucked out of the market into this like liquidity void. And so it's smaller than reverse repos. But it is a meaningful percentage of it, and especially when there's already liquidity issues in the system, it's certainly a meaningful variable. I think it's really concerning for quarter three or quarter four. I think right now we're in a little bit of an eye of the storm, where, like I said, liquidity indicators look okay, looking out a couple months, because you kind of have liquidity being taken out and other liquidity being put in, and the question is when you get towards the later part of this year. When a lot of these things all coincide to kind of be bad for liquidity and bad for growth, I think that's where storm clouds hit. And how concerned to be partially comes down to how you think people are going to navigate it, right? Because this is an actively managed system, and a lot of it will come down to human decisions. And there's ways to cause a massive liquidity shock, and there's also ways to just kind of like flood it with liquidity, and kind of weaken on the inflation fighting front. And so I think it'll be pretty pivotal decisions by the Fed. I think an instructive period to be familiar with is the repo rate spike of 2019. That was the last time that quantitative tightening ended. The Fed was drawing down their balance sheet in 2018, 2019, and they did so until September 2019 when they caused their repo rate between banks to blow out. And the Fed had to come in and participate in the repo market. But there are a number of us at the time that were pointing out that they were basically, the system was being flooded with T-bills, and the Fed was going to have to start buying some T-bills, and about 3 weeks later that's what they had to do. And I think we're kind of in a similar environment now, where right now they're still trying to be tight with their actual balance sheet, but then they're offsetting it by loans. And I think they're going to find a time later this year where they're unable to keep doing quantitative tightening. It doesn't mean that it necessarily turn to QE right away, but I do think that at least on one of those liquidity fronts, that quantitative tightening portion, I think that's likely to stop, because there's not much else liquidity that can come from the system. And I think that's the thing that I think they overall kind of basically overestimated how much liquidity is in the system. And another factor that's challenging is that the Treasury generally has options. I mean, they could, for example, when they want to refill their Treasury General Account, they could issue almost entirely T-bills. They could issue a flood of T-bills, and that would pull liquidity out of the reverse repo market most likely. And so that would actually be the least harmful way for liquidity in order to carry on. But of course, it would shorten the average duration of U.S. Treasury debt. It'd be the least interest rate effective way to do it. So again, it kind of comes down to like choices by Yellen and others of how they want to handle that. And one of the things we've seen recently is that they don't generally respond well to technological changes. And technological changes are things that kind of move slowly, but then they move all at once. And what I mean by that is when you look at the history of fractional reserve banking, it's kind of based on the premise that the settlements are slow and the transactions are fast. And what banks do is they provide that arbitrage in between. So if you go back to, say, a gold-based free banking system or something like that, the gold itself is slow, But then once you say deposit gold in a bank, you're now part of this like telecommunications connected global ledger that allows you to move money around quickly. And so there's relatively, few reasons why people want to pull their money out. It's generally like you're pulling it into a slower state when you pull it out of the banking system. And so they kind of rely on people wanting to have their money in the banking system to benefit from that speed. What we've seen kind of in recent years, recent decades, is that the settlement speeds have especially it's all fiat now, but even in a fiat system, when you add social media, when you add, some of these banks that failed, for example, they had software APIs where they could just tie their money management right into the business's software. So like people could basically pull their money out without really interacting with the bank in question. And the easier it is to deposits to move around, the more it changes liquidity needs for these types of banks, right? You can't cut it with like 5% of deposits covered by liquid cash. There's a broader discussion around fractional reserve banking in general, but even among fractional reserve banks, it's like there's different levels of liquidity. It's like, can you take a 5% bank run, or can you take a 50% bank run, or anywhere in between? What's the number? And basically, as that speed mismatch between settlements and transactions has closed, and as like the settlements can move around super quickly, those liquidity thresholds that are so low don't really cut it anymore. And so the Fed's basically ironically pulling liquidity out of the system in a world where, because of technology, they need more liquidity. When we zoom out to kind of the bigger question, I often bring up the 1940s, and that's really what they find themselves in. So if we go back to the 1970s, the inflation that was happening was a couple key reasons. One is you had the highest ever rate of U.S. bank lending, and that was in large part because the baby boomer generation was entering their home buying years. So you had most of the money creation was from bank lending. Then number two, that was exacerbated by there were larger fiscal deficits. Now they were actually a smaller component of money creation than bank lending, but they were still adding fuel to the fire. And of course, you had oil issues, right? So domestic oil production peaked in 1970 after like literally going up for like 100 years, and then as it started to go flat to down, we became more reliant on imports, and then obviously we ran into geopolitical issues in the Middle East, where we got like cut out of the market for periods of time. And so the combination of supply side limitations, but then also record demand for loans, really caused a lot of money creation and inflation. And generally, the tool that central banks have to deal with that is a tight policy. Especially because debts as a percentage of GDP, both public and private, were very low back then. And so they could radically tighten monetary policy, get to really positive real yields, discourage a lot of types of borrowing, put the economy into kind of a controlled recession. They basically crushed Latin America. I mean, basically they had all this dollar-denominated debt. The dollar spiked, and Latin America had a lost decade, and that basically took demand out of the global market so that basically United States could have more of it. So it's kind of like throwing one person under the bus to keep yourself afloat. That's the policy they could go with. The 1940s were a different environment, which is that the money creation was almost entirely from fiscal spending. There was no excessive bank lending. Banks were barely lending at all in the 1940s. And yet that decade was just as inflationary as the 70s, because obviously you had massive monetized fiscal deficits to fight the war. But then a lot of that, went to domestic manufacturing. When the soldiers came home, it put like 8 million of them through technical schools and college and mortgage assistance and things like that. It's just basically a gigantic stimulus in a way, monetized, inflationary. And when the Fed had to deal with that situation, they basically lost independence. They said, well, we have to keep borrowing costs low for the war. And ironically, if most of the money creation is coming from fiscal spending, raising rates doesn't even necessarily address it, because the government's not going to spend less because rates are high. And now their deficits are going to be bigger because they're paying higher interest on their debt. And so actually, unlike bank lending, the interest rate channel is just not a very effective way to deal with fiscal driven inflation. But the most effective way to deal with fiscal driven inflation is to reduce the fiscal deficits, which is not a central bank. It's not in their purview. It's in Congress and the president. And so basically it's like their current environment is that here in the 2020s, most of the inflation's from large monetized fiscal deficits as well as supply side constraints. We don't have excessive bank lending. There's pockets of excessive bank lending, but it's just the normal kind of historical baseline of bank lending.
Yep.
And yet they're treating it like it's the 1970s, which is they're treating it as though it's low debt, as though it's mostly from bank lending, and therefore if you're tight enough with rates in QT, you can somehow constrain it. And sure, you can for a period of time if you cause an outright recession. But if you actually want to get to a period of disinflationary growth, the ways to do that are improve the supply side, so better access to energy and things like that, as well as restructure some of the deficit spending. But neither of those are actions that the Fed has. And so I think that one of the problems is that we put so much burden here on the Fed to deal with it. And it's just not, they're only one part of the puzzle in this kind of mess that we've created over the past couple of decades. And so
right, the weapons they have are not effective, or not as effective for this particular situation.
Yeah, and the challenge is that, so the way that they dealt with it in the 1940s is, one is they kept rates low despite high inflation, but then the problem is if you keep rates too low during inflation, then you can actually encourage excessive bank lending because, like right now in Turkey, if you can borrow lira for a low rate, why wouldn't you? You buy almost anything else if they're not going to raise rates to positive real levels. And so if they don't raise rates in response to fiscal driven inflation, they can then encourage bank lending driven inflation because everybody wants to borrow more of it, create more of the currency, and buy something harder with it. Mm-hmm. And so what they generally turn to is a mix of keeping interest rates low or moderate, and then doing capital or lending controls, which obviously is a big problem in its own right. And so I think that's kind of the environment that we find ourselves in going forward, where they have limited tools to address inflation directly, unless they want to cause an outright recession. And even if they do, then the question is, well, what do you do after the recession? How do you accelerate without causing another round of inflation?
Right.
And I think one of the things they're going to try is just basically tighter restrictions on bank lending. They're basically trying to slow down bank lending while still keeping treasury markets liquid. And it's kind of the 1940s playbook all over again.